Hello, welcome. We're just going to wait a couple of seconds whilst people enter into the webinar room, and then we shall get going. So excellent. So thank you very much and welcome for joining our athletes, entertainers and influencers roundtable. This is a roundtable webinar in a podcast format to try and be a little bit more engaging through conversation and insights from our panel. My name is Rob Hazelton. I'm the head of marketing and business development at Nexia, and I'm based in the United Kingdom. I just want to read a little bit of housekeeping for this session. So first of all, this session is being recorded, and all registrants will be sent a copy of the recording along with some additional documentation after the event. But in order to ask questions, and we do heavily recommend that if a subject comes up that you're curious about, that you do ask questions, that you use the Q&A function at the top of your screen. We will be monitoring this during the session. But if you have any more detailed questions or questions that are not answered during the session, you're more than welcome to contact and connect with the presenters. The details are available on the registration page, but we will again share them in during the session at the end of the session. A little about Nexia. So Nexia is a leading worldwide network of independent tax, accounting and consulting firms. We provide a comprehensive portfolio of audit, accountancy, tax, advisory and business services. We have over 230 firms in more than 135 countries worldwide. Nexia was established 25 years ago, well, over 25 years ago, and our continued success is thanks to what lies at the heart of our business. International knowledge, this is an example of that, proven experience and enduring relationships. When you choose Nexia, you get a more responsive, more personal, partner-led service across the world. So now on to our stable of talent. Our moderator today is Mishkin Santa from the Wolf Group in the USA. Mishkin is a principal at the Wolf Group and oversees the firm's international tax services. We are also joined by Kathy Johnson from Nexia Safri in the UK. Kathy is a partner and a member of the firm's sports and entertainment group, specializing in advising individuals and organizations active in all areas of sport, TV, film, theatre and music. And Adam Barsikowski from Nexia Adversaro in Poland. Adam is the chair of Nexia's Global Mobility Tax Services Business Group. He is responsible for the network's approach to all GMTS services. And so with that, I'll hand over to Mishkin.
Thank you for the warm welcome, Rob. There is so much to unpack when we talk about the taxation of athletes, influencers, and entertainers. I mean, if you just think about the various income streams that these folks generate, especially since, you know, COVID and post-COVID era, we're talking about sponsored content, affiliate marketing, ad revenue, production collaboration, merchandising, event appearances, digital products, crowdfunding, licensing content. You know, the streams can go on and on and on. The expenses that match these items of income can also be various in nature as well. And so when we're dealing with these folks that can be either one of the three, athlete, influencer, or entertainer, or even all three together, right? We have athletes that are also entertainers and influencers and all around. One of the common questions that I get from the very beginning is, Mish, how do I report my income? How do I even keep track of it? How do I report it? How is it going to get taxed? And so today we're going to start with that question, and I'll start with Kathy. Kathy, how do you guys deal with that question in the UK?
So, hi everyone, I'm Kathy. I'm a partner in the sports and entertainment team at Safri in the UK. And I work in all of the different creative sectors, so sport, TV, film, music, influencers, gamers, anyone that performs their services in front of the camera or work behind the camera. So we work with both UK-based resident individuals, and we also work with non-UK tax resident individuals. And so the answer to that question, dependent on your residency status, is quite different. So for UK individuals, they will be taxed on their worldwide earnings wherever they perform their services. They will be deemed UK tax resident, and therefore all of that income will be reported on their UK tax return. And that will be either via the company that they trade via, or themselves as a sole trader, that will be going into their profit and loss account on their personal tax return. For the non-UK resident individuals that we work with, we look at their UK arising income, and therefore we look at we look at their performances in the UK and any income associated with those performances. So for a sports person, for example, they may come into the UK and play tennis. They don't just earn some prize winnings, they'll also earn some endorsement income. So we have an apportionment of that income coming into the UK because HMRC would deem that income taxable on the basis that they would never have earned it had they not have participated in the UK.
And Kathy, what are the tax bands or the tax rates that those folks are getting taxed at? I assume it's some form of ordinary income that's generated there.
Yep. So the UK resident individuals or UK citizens or Commonwealth citizens are all allocated a UK personal allowance. So their first £12,570 at the moment is taxed at 0%. The tax rate then goes up to the mid 30,000s at 20%, then up to 125,000, 40%. Anything over and above that is subject to 45% taxes.
Right. Okay, Adam, let's go to you. How is that income looked at in Poland, and how is it taxed?
Yeah, sure. Hi, and thanks for the welcome. So my name is Adam Barcikowski, as Rob explained, and I'm tax manager in Advisoronexia. We're located right in the heart of Warsaw, Poland, dealing in taxes, legal services, accounting, and payroll. And I'm mainly dealing in international tax affairs, so also more and more with influencers and athletes who tend to go abroad more often these days than even just 10 years ago. And they tend to generate more and more income. So how to approach it? As in case of UK, and as I'm familiar, majority of the EU jurisdictions, first and sometimes the most complex element to answer this question is the tax residency status, because it's not so straightforward as spending some time in a given location. There are some additional elements that we will be speaking about later on, as I believe. However, the tax residency is the main element that we need to determine. And then we go to, if we have a tax resident in Poland, let's say, then he or she needs to, let's say, take out the empty baskets and apportion each income to a given basket. This is maybe some kind of a characteristic of a Polish tax system, but as I know in other EU jurisdictions, like in Germany, for example, it's the same. That's you take each and every income and you have to ask yourself the question, what type of income is this? And because we don't match different types of income with each other, which consequently also results in not matching the costs with each other. So, for example, we can have an income from sole trader business, like personal business activity, and then we have costs allocated with it. For example, providing some services like professional services, even marketing services. Or we can have a person who has not established a separate business, but is simply an individual who started generating money out of his hobby, which was, for example, influencing online, then the income may be of a different type, like a license fee, for example, for using a personal image. Here we won't have costs, we will have a lump sum taxation of 20%. But the person can also be somehow employed by another, his contractor, or can get some fees for example, intermediary with the sales of products that he advertises on his profile. And here we have different methods of taxation. So we can either establish a business and then we throw everything into the business activity and we can tax it with flat rate 19% and allocate the costs, or we can go to lump sum taxation like license fees without costs, or even we can tax at also a form of lump sum taxation, which is that we simply take the revenue without the cost, but we can go down with the tax rate and even up to 8.5%, for example, if we are speaking about intermediary services. So to sum up these parts, yeah, it can come quite tricky because the allocation to each basket is not so straightforward. So it may depend. I mean, the given income may be allocated to either an intermediation or a license fee or an employment income, depending on how it is structured from the legal perspective. So actually, we have to develop it properly from the tax perspective, but also follow the legal aspects. So the agreements, the contracts, and so on. These are also very important from our perspective.
So what I'm hearing is you're grouping the income into various streams by type. And then there's a wide variety of different ways that income can be taxed. It sounds like you said rates as low as 8%, maybe 8.5, up to 19. Are there rates that are higher than 19% if it's not done properly? So in other words, can you generate some significant savings by doing some pre-planning of the income?
Yeah, sure. So the highest rates that we can go up to is actually 32 or even 36%, because now we have also the 4% of a so-called solidarity surcharge. So over 1 million zlotys, roughly 250,000 euros a year. So you can go even up to 36%. Okay. If you don't plan at all. So if you just get some money and let the tax authorities do the job, they can go up to 36% if they want to, and they are tempted to do so. And if properly structured, you can maneuver between flat rate 19% or allocate part to the one basket, which may be taxed at 12 to 32, for example, and then to flat rate taxation, and also some to this lump sum taxation, which can go even as low as 8.5. So it's a matter of pre-planning. Yeah.
Got it. And we'll get into business entities and how you can layer those. And I think, Adam, we're going to talk about the Polish Family Foundation and maybe how that can help out. Very quickly, in the United States, the way it generally works is most types of influencer income, athlete entertainer income is going to be either wage income or sole proprietorship income that's taxed at ordinary income rates. We'll talk about how you can write off expenses against that income here shortly. But if it is sole proprietorship income, you will have to pay income tax plus self-employment tax. Plus, let's not forget that we do have certain states that have state income tax that's on top of that. In some cases, some of the income can be what we call active royalty income, which is similarly reported as sole proprietorship income, and you can write off expenses against that. And then there's also passive royalty income, which is reported in a different area of the U.S. tax return. That also, you can take expenses against that as well. It is not subject to self-employment tax. So in some cases, there could be a nice little tax savings there by having the income classified as passive royalty income. And then in the rare occasion that you're able to, when we get into kind of intangible intellectual property area, you may be able to convert the passive royalty income into a capital asset and get into the nice U.S. capital gains tax rates, which we tax those capital gains tax rates, at least right now, at 0, 15, and 20%, with an additional 3.8% for the net investment income tax. So, up to 23.8% for the capital gains tax, whereas with the sole proprietorship or wage income or active royalty income or even passive royalty income, you're looking at progressive tax rates up to 37% plus the state income tax on top of that. I will caveat all of that by saying that in the United States, our tax code, our federal tax code, is set to sunset at the end of 2025, and likely we may have new tax rates as we go into 2026. So something I think for a lot of those folks to be aware of. I will just make a couple other comments here, which is rule number one that I tell, or advice item number one that I tell a lot of influencers is get a bookkeeper. Bookkeepers, in my opinion, are worth their weight in gold. As Adam said, you want to kind of parcel out the various streams of income. I think it's really important to do that in the US because you don't want to take an expense for one stream of income and try to allocate it to another stream of income. So it's very important that the streams of income and expenses are very clear on how that goes in there. The second thing is that, entertainers and athletes, the area of tax around those folks is well developed, has been for years. They generally have contracts that are written in such a way that it's easy to tell how the income is sourced and the streams of that. But for influencers, this is something new, especially when you get into name, image, likeness rights. They don't really formalize a lot of that in contracts. And I think getting an attorney to write out a contract to specify, this is how the income is going to be paid. This is how it's going to be classified. In the US, we like our forms. So is it on a 1099 NEC, 1099K, 1099 miscellaneous? How's it coming through? I think all of that is very, very important. And then lastly, you want to get an accountant that really understands how to deal with the complexity of the influencer taxation, because it's not as simple and straightforward as the old school method of entertainers and athletes, which is still complex, but well developed, as I said. Okay, so with that, let's go on to the next topic.
Could I ask you a quick question with
Sure,
regards
Kathy,
to the US? When influencers are given assets to promote,
yes.
How do you guys tax that?
We do. So we normally tax that at ordinary income tax rates, but I'm glad you brought that up, because going back to step one with the bookkeeper, I think that's one area that the bookkeeper, when I talk to a bookkeeper, it's like, this is what I'm trying to solve for. I got someone that's getting cash and what we call in-kind compensation, right? Which they may think in their head, oh, this is a gift that's not taxable to me. I was watching the Olympics and I see all these young athletes wearing Hermes and Louis Vuitton and whatever it is. And I'm like, ooh, that looks to me like in-kind compensation. They probably think it's a gift from those people, but when they're wearing those items and they're influencing and they're getting clicks for it, and the things that drive the income from influencers, that is going to be considered income by the IRS. And the IRS did point to an old FAQ they put out back in 2015 related to the swag bags that you receive at different events, for the Emmys and the Oscars and all that stuff, and how those items of income are going to be reportable and taxable at ordinary income tax rates.
Wow.
So how's that done out in the UK? Are you guys looking at in-kind compensation the same way?
Yeah, absolutely. And I guess it's some of our influencer clients are quite young, so it's quite the educational piece in terms of just explaining why these things are taxable and on what basis they're taxable. And I think the grey area for influencers that I find is that a lot of kind of the new kind of hot up and coming people online who have a lot of followers get sent items to promote with no expected promotion, and therefore there isn't kind of a contract of services there, or and then it soon becomes kind of a formal arrangement where brands are sending your client something in exchange for posts or promotion, and therefore there's clearly a taxable supply there, and it's about valuing that supply. So let's say it's a bag. That bag should then be valued at market rate, and that's the figure that goes on your tax return as your income. A lot of influencers that I look after then go on to sell those items, and therefore you have another supplier, another
Taxable
taxable
event.
income generated. And it's just tracking that all the way through. So what you just said about a bookkeeper is absolutely imperative to making sure that all of these books and records, and also just having a separate bank account. The other thing, quite a straightforward thing to advise these guys to have, but just a separate account where it's all tracked makes your accountant's life so much easier.
Or accounts, plural. Kathy, how do you deal with the influencer that says, I was sent these products, but not for me to have? I'm testing them to see if I want to recommend them to my audience. This is, for me, not compensation. And for them, they're looking at it like research and development. How this isn't income to me. Are you sure it's income? How do you deal with that aspect?
Yeah, I think like HMRC's view on that has become clearer. It wasn't very clear, say a year or 2 years ago, but their view now is quite clear in that if it's kind of a low value product, I say £250 or less, then it's kind of immaterial. But anything over and above that, we must consider as income.
Okay, so even if they're just testing the product out, too bad, so sad, it's in-kind comp.
Yeah, if they're promoting it, then yes.
If they're promoting it.
Yeah.
Okay.
Yeah.
So if I like it, I test it, and I'm promoting it, then
yeah, exactly right. Exactly right. And we've seen HMRC with my clients kind of screenshotting the Instagram stories. So it's like a 24-hour story that goes on your Instagram, and then it's gone. So again, it's that educational piece, just letting the influencers understand that HMRC are looking at these things, and they are, putting their research together.
Looks like we have a question from Rob. Rob?
Yeah, hi, thanks so much. I've got a one question from Alfredo Saloa. Do streaming platforms like YouTube, Twitch, or sports broadcasters have any withholding tax obligations when paying performers?
So in the US, they definitely would. And hello, Alfredo, good to hear from you. In the US, they definitely would, but mostly for the non-resident aliens. So for example, we talked, Kathy and both Adam were talking about, classifying, are you a resident or a tax resident or a non-resident alien? Well, if you're a non-resident alien, then generally the withholding rate is going to be 30%. That's the default rate. However, if there's a treaty, then perhaps you can get a lower withholding rate. And then the question is, what type of income do you have? Where does it fall into the treaty? That's one of the topics that we're going to talk about. But let's go to Adam on that same exact question. Do you have a withholding tax rate from that type of revenue from YouTube?
Yeah, basically there will be the same, but as the tricky element will be what rate to apply, because
right.
Which platform we take into consideration, then it doesn't mean that YouTube is a US company. So it may be, I don't know about YouTube, but it was about Facebook, at least in Europe, which was registered in Ireland, I believe. And they were streamlining all their income from marketing through the Irish company. And then we can dive into much more complex issues of beneficial ownership, real economic activity of that company, etc. Because the company is actually it works like that. That's as an individual is that they will take this this withholding tax at their home jurisdiction. So the influencer will get the money net, and basically most of these companies are not located, at least in Poland, but there were in other jurisdictions, as I am aware, questions whether, for example, really Ireland is the place that should withhold this tax, whether the Facebook, which has, for example, some servers located in Sweden or somewhere else, doesn't have the presence over there, and the Swedish tax authorities would like to take the withholding tax. So this is not a burden on the on the influencer to care about, but this may influence what money he or she will get in the end. So if the tax in Ireland may be significantly lower than in Sweden, or even zero, But Sweden, or there was a case with Spain, I believe, but I don't know, with Facebook, with some other streaming platform, which was some kind physically present in that country. And then that country may claim that actually this income was generated over there, not in the place of registration, because of the beneficial ownership clause. So saying that actually the Irish company is not the beneficial owner of that. I believe that the US also has some tools to deal with this, because when the platforms are registered in some offshore locations, but actually the beneficial owners are somewhere in the US, the IRS can go after the withholding here.
They can, and it just depends on what the treaty says. I think what you're highlighting, if I'm hearing you correctly, is that this comes down, I think, to what the treaties are telling us, and then having experts in both countries, which again, this is why I love the Nexi network, because I just reach out to the folks at Safri and I say, hey, I need someone that knows the Irish tax to help me out here. Is this really the withholding that we got to deal with, or can we lower it and deal with that? What are you seeing, Kathy, with that question? Are you seeing? I'm sure you're seeing a ton of withholding tax issues.
Yeah, I do see lots of withholding tax queries coming my way, and the answer usually is looking at where the payment is coming from, and who the payment is going to. So the payer, where they're resident, and where the recipient is tax resident, and looking at if there's a tax treaty. There's a default position usually. So if the UK is paying an individual who is US resident, there'll be a withholding tax position. We then look at what type of income is being paid. So if it's business profits, there'll be a different rate, probably to if a royalty is being paid across border. And then we look at ways to reduce that withholding tax. So the treaty usually suggests that if we have two tax treaty friendly countries doing business with each other, we can request paperwork from the recipient that suggests or proves that they are tax residents in that jurisdiction, and we can lower the withholding tax rate, sometimes to zero, mostly with royalties to zero, which is helpful.
Yeah, that's a very nice provision if you can get into it. And similarly in the US, we have a form, or forms, depending on if you're an individual or a business entity, the W8B and W8B and E forms that you complete. And then within those forms, there are certain sections where you can take your treaty positions and you can verify that this is the treatment that you should be getting, and therefore get the withholding tax done. For residency certificates, I can tell you from the US side, those are very difficult to get right now. So if I've got someone meeting the substantial presence test, or a green card holder, or a US citizen, and I'm trying to say, like, this person is that status, but there needs to be proof of that, or US partnerships, corporations, things like that. There's a residency certificate that you can obtain with the IRS, but that process is very, very long now. It's taking forever for folks to get those certificates, and creating a lot of headaches with withholding tax. Okay, let's move on.
This is a key. I may add that this is a key with withholding, at least from our perspective, because if you don't have a residency certificate, then you just pay 20%.
Right.
And you don't have any choice. So basically, we have a lot of cases which tend to go down to the element that the residency certificate was not disclosed on time, but it was somewhere. So the clients had to withhold 20%, and now we are trying to refund this tax.
Which is always a nightmare.
Especially if you want to get some, residency certificate from other jurisdictions, and then it may occur that actually it's not a residency certificate, but confirmation of registration or something else. It's not the same. Yeah.
Right. Rob, you got another question for us?
Yeah, sorry, just before we move on, there's a follow-up from another member in regard to that question. Does double tax conventions, if applied to the case in matter, can that have important weight in compliance issues? And can we, maybe one person answer this, then we move on to the next subject, if that's okay? Do you need me to reread that?
No, I think we got it. Kathy, do you want to field that one?
I'd like you to reread the question.
Okay. Yeah, Adam or Rob, can
Absolutely.
You reread that one?
So in relation to the question we're answering about, withholding tax obligations,
yeah.
Does a double tax convention, if applied, Can that have important weight in compliance issues?
Yeah, I mean, each individual country will have their own domestic tax law in terms of what they expect in terms of compliance, and whether individuals that trade around the world or perform their services around the world will need to file a tax return. Where the tax treaties and the convention is really helpful is defining where that individual is ultimately resident, and therefore will define which country has primary taxing rights on that income, and that's the basis of any individual taxpayer's compliance. Does that answer your question?
Yeah, I'll follow up on that really quickly, and then we'll move on to the next topic, which is, in the US, if you don't use the treaties to your advantage, the withholding will be at the maximum rate. And then if for some reason the actual tax due is much less than that, good luck trying to get a taxpayer identification number. Then you got to file our crazy forms. Then you got to get then the refund's got to go to a US bank account, because we're not going to send the money to an offshore bank account. So I think the answer to the question, at least from the US side, is yeah. I mean, you want to try to get it structured from go with the best possible outcome under the treaty, so that you can avoid having to do all that back end stuff. The back end stuff, I think it just creates a long cycle time, a bad client experience, all that stuff. Moving on to the next topic, which are everyone's favorite topic. I'm sure you guys get this question all the time. How do I write off my expenses? What can I write off? What can I take? And in the United States, I can tell you that the big issue that we have with influencers, we classify influencers into 4 different types. You have mega influencers, macro influencers, micro, and nano. And sometimes with the nano influencers, they're not really making any money. And so the IRS says, well, you're not turning a profit, you have a hobby. And so you're writing off all this stuff, which you shouldn't be writing off, and you're writing it off against ordinary income, and they'll come in and do what's called a hobby loss audit. And you got to be really careful with that, because we have a bright line rule that says 3 out of your 5 years have to be profitable. If basically you go into a loss status for 3 out of 5 years, the likelihood of you getting a hobby loss audit and then having the IRS come back in and removing all those deductions and expenses and owing a bunch of tax plus penalties and interest is quite high. Also, again, I think we all talked about this earlier, you want to match the expenses to the various streams, goes back to my bookkeeper suggestion. But most of the time, as long as we have what are called ordinary and necessary and reasonable expenses, and what are those for influencers? Those can be a little different because of the nature of what they do. They're not going to look like the same expenses that, say, I would take as an accountant. But as long as they're related to what they do, and they're reasonable, I think you can definitely deduct those, as long as you have an actual for-profit business that has a profit. Let's go to Adam on that one. Let's talk about expenses. What are you seeing there? What can be taken? What's your advice?
Yeah, basically the general rule is that you can deduct everything unless you can't. So it has to be related, as you said, as in the US, with the income generated or possible to be generated, which may be a little bit different, because we do not have to have the income yet generated to be able to deduct the costs. So if we can justify somehow that this cost is for securing the future source of income, or upholding it somehow, like for some reason an investment, but cannot be put into a fixed asset, let's say, but then it is possible to deduct it. A little bit similar rule is with the VAT, which is also a topic to talk about, but we didn't touch it here. But there are a lot of elements with VAT, especially in the EU, with import of services, etc. But as far as expenses go, we need to prove that they are at least indirectly related to an income, or to the securing the source of income. So to making sure that the source of income will be higher or will occur at all in the future. And it has to be documented. This is the other thing. So you have to document it, not not necessarily with a formal invoice. It's the best, but actually invoices are more important for the VAT purposes. For income taxes, you can even use receipts or other proofs that you have actually incurred an a cost, and which of course says what type of cost it is. So it cannot be like payment according to agreement if you don't have an agreement, for example, to show what it follows. So you have to be able to prove it that you incurred this, when, for what, and justify why did you need it. And in this last thing, especially with influencers, it's similar as you say. The tax authorities are quite conservative, so they, influencers can prove a lot of expenses, some kind of expensive hotel somewhere. Let's take an expensive hotel in Canary Islands, and they claim that they really needed this 5-star hotel to record their content. And the tax authorities may come down to claiming that, okay, but why didn't you take like a 3-star hotel, which was 3 times less expensive? So it is a discussion of this kind. So some kind of rationality must follow after that.
Right. I mean, we talk about the cost for building websites, promotional content, computer equipment, internet bills. I mean, for athletes, I saw the other day, there's a very famous National Football League player named Derrick Henry, plays for the Baltimore Ravens. I think he makes $10 million a year, but he was detailing that for the food that he eats, he spends $250,000 a year on the food that he eats, which is mind-boggling to me. I have a family of 4. I don't pay close to that amount, but for him to make his body work and to do what he does in the National Football League, he was detailing kind of what he ate and what he spent his money on. It's super interesting to see, and I'm sure that's an area that has to be justified to the IRS whenever he takes that as an expense deduction against his income. What about you, Kathy? What are you seeing out there for the various folks you're serving?
I mean, expenses allowable must be exclusively for the purpose of your trade. And so I guess the arguments that we see with HMRC are things like clothing that's bought for castings or red carpet events or bands who might wear a particular outfit, and the duality of purpose point. So HMRC will argue that the moment that that band might step off stage, or the moment that the influencer might, leave the casting, they're still in those clothes, and then they're going to home, or they're seeing their friends or whatever. So it's a difficult task sometimes proving that those clothes were, unless a band, for example, sometimes wear a very specific outfit on stage, and therefore it's very easy to prove that they would not be wearing that at the bar after the show. So we see lots of arguments there. And we see some kind of weird and wonderful expenses as well, sometimes kind of cosmetic expenses, dentistry, and it's about proving. There's a very high profile case in the UK where somebody had some cosmetic surgery, and she managed to prove that her income as a result of the surgery that she had rocketed from that point that she had that surgery, and therefore it was accepted that that's a business expense. So it's about kind of locking your argument in as to why this is a exclusive business expense. Entertainment is a hard no in the UK. Going out for dinner, entertaining, taking clients out is never allowable.
Really? Okay.
And I guess logistics of expenses, we have an app for our client where they literally just take a picture of the expense, and then it kind of whips into our system. And again, that separate bank account is really helpful if they have that separate account, that one card that they use for business expenses that isn't kind of messing it in with their personal affairs.
And does that app pre-classify the expense and do all the heavy lifting, or you still have to kind of enter in some info?
Yeah, it does. It kind of interacts with our software, and it allocates the expense to the relevant ledger. So we might, at the end of the quarter or the end of the month, whenever we do that particular bookkeeping exercise, we might have a few queries where it doesn't recognize some of it, but I would say 98% of the time it does recognize what the expense is, and it's really helpful.
Got it. Okay. Let's move on to the next topic, which is, I think, one that I get asked this all the time. Should I form a business entity? I need to get an LLC. I need to get a series LLC. Mish, you told me I have 10 different types of income. I'm going to do a series LLC, and I'm going to create one LLC for each type of income. How do we think about, business entities and trusts and things like that? Let's start with Adam. I think Adam, one of the things that I learned about from a recent conference I was at with you was this new family foundation that is in Poland. Or maybe it's not new, maybe it's just something that we're just now talking about. But what are some things that some of these folks can do? Should they do business entities in Poland or entities in general? And what would you recommend?
Yeah, sure. So the business entities come down to actually, with respect to influencers or folks like that, it will come down to a form of LLC or other legal person, because LLCs are always tax opaque in Poland. They cannot be tax transparent, as well as in Germany or France, etc. And yeah, you can set this up and streamline all the income through the company. Then you don't have the problem usually with high social security contributions, because this is another thing that we have apart from taxes. There are some, but not so high. But you can also apply the 19% flat tax rate with the costs, as we spoke before. But you can also come down to 9%, because we have this rate for small businesses, which small companies up to 2 million euros a year of revenue may use. So the flat rate of 9% is what is accessible for these companies. The drawback of that, especially with respect to people who the professional and private life are not much divided one from another, is using the money, because the money that goes into the company stays in the company. If you want to take it out, you pay the tax, the 19% on the dividend or any other form that you want to take it out as a remuneration and so on. You have to pay the tax. So you come to double taxation with this company. So companies are good, but you have to be aware of the fact that there is a little bit more operational planning with the money that goes into the company. And this is also the element with the family foundation, which we have. So a family foundation is basically a trust. Okay. It is a relatively new form in Poland, and it follows some other European ideas, like the one that is, for example, in Liechtenstein or in other jurisdictions. And what it is very good for is that it allows you to reinvest the money tax-free, basically. So as long as you put the assets, because you put the assets there, and the assets generate the income, then you can reinvest this income. And as long as you don't take the money out from this family foundation, so pay it out to you or other beneficiaries that you may have, like a family or so on, it all goes around tax-free. And this is one of them. Yeah, it follows like this Liechtenstein solution, but there are some taxes with that, as I am aware, and especially some provisions. And our solution that we have, this family foundation, is very relatively cheap, actually, because the maintenance fees are not so high. So you can put any assets basically in there. There is some closed list of activities that the family foundation can provide, but tax-free, but it's very broad. So it may even be managing capital assets. It can even be forestry and agriculture and so on. So as putting a personal image in there, for example, for an influencer, and getting some money through it is an idea to manage this cash flows in a very tax efficient way. Still remembering that if you get some money to the family foundation, you shouldn't pay for your dinner with the family foundation.
Same restrictions as the UK. Be careful with that.
Yeah.
With that
be careful with that, especially that there are some restrictions of hidden something like hidden dividends. So tax authorities may scrutinize the expenses and see whether these were actually not, concealed payments out of this. And the one difference, maybe for you two guys, from the common law systems, is that a family foundation is a separate legal person, so it is not
separate. It's
separate,
opaque from
yeah.
It's its own thing.
Like
Okay.
like a corporation, yeah.
Got it. Rob, we got another question.
Yeah, so I think that point segued nicely into a question from a while ago from Ali. You may already have gone over it, but just with that, those words from Adam, it made me bring this in. If someone is gifted a brand trip, so flights or a stay by a company, is the totality of the trip, food, transportation, hotel, excursions, etc., is that taxed? Or are there, I guess, expenses that can be put against that or whatever? How does that work?
Yeah, in the United States, we would probably look at the whole thing as income, ordinary income. Now, some argument could be made that certain portions of whatever is received are fringe benefits, depending on the relationship of who's giving you those things. But the most conservative position is that the whole thing comes in as taxable, and then you kind of work your way backwards and say, well, okay, is anything that I'm doing there kind of related to the content that I'm producing, or whatever I'm doing? Can we use that as a deduction to write off against the income? Things like that. And then the fringe benefit, I think, is you got to be a little careful. It's a medium risk kind of argument that you have to very well document that it actually is a fringe benefit and not something that rises to the level of in-kind compensation. Kathy, do you want to field that a little bit, and also tell us about business entities in the UK?
Yeah. So with regards to the like the holiday break, exactly the same really. But I guess the slight difference is that we would put the entire value of that package on the top line. So that would be your income. And then we would probably contra some of the items as expenses, because you'd still need to eat and you still need to probably, do certain things. So we would take a proportion of that from the income on the basis that those items would ordinarily be tax deductible in any case. And then with regards to the question about trading in the UK, so we generally have a couple of ways to trade, which is a sole trader, where you are filing a tax return based on your profit and loss during the year. It's a very flexible way to trade because you can take all the money out because you're taxed on it, regardless if you draw it out of your bank account or not. It's completely confidential, which is why quite a lot of people in the UK like trading that way. The other way is through a company. The company setup has become a little less attractive recently because our tax rate went from 19% up to 25%. Probably going to go up again because we will have a new budget at the end of next month where we are expecting all taxes to go north, unfortunately. And the company has a lot more administration as well. So the company comes with company's house filings, statutory accounts, corporation tax returns. You then have to get the money from the company into the hands of the recipient. So there'll be a personal tax return. So the tax savings of trading via a company need to be quite substantial to, outweigh the professional costs that you now have and the additional administration that you now have dealing with the corporate setup. The other point is, and the more kind of high profile you get, the less this is attractive to you, is that all of your details are held at Companies House. So it's not confidential. The press in the UK love looking at Companies House, and they love pulling sets of accounts and putting it in the press what high profile people earn. The full accounts aren't at Companies House, but you can see things like how much tax people pay, how much profit they've made, and how much cash they have in the bank. So you do see what balance sheet items you have. And again, it depends upon how much you want to extract out of your business and how much you pay yourself. If you are an individual that doesn't need that much money to live on, and a lot of that money stays in the company, it can be a very cost-effective, tax-effective way of trading. and at the end of your career, you can do a capital distribution and get rid of that company at a very effective tax rate using our entrepreneurs relief, paying like a capital rate of 10% on some of that income, which is quite attractive. But if you are an individual that spends quite a lot of money and extracts quite a lot of money from that company, then it's less tax effective.
3 follow-up questions for you. First one, when you say company's house, you mean beneficial ownership, right? That's the.
Yep.
Okay. I mean, we're not talking about Paradise Papers or Panama Papers or anything like that.
No.
The second one is for business entities. I think we talked about this previously, but I was asking, is it a common strategy to set up a pension, a retirement plan, a SIP? Do you kind of do that retirement planning when your client comes to you?
Yeah, we do. So we don't do that at Safri, but we work with lots of financial advisors who do provide that advice. It's very tax efficient to do that either as a sole trader or within a company. It's a deduction in a company. If you're contributing to a pension as an individual, it's extending your basic rate band. So in either scenario, it's a great idea to put some money into your pension.
And you referenced the last question, and then I want to get to you, Adam, on beneficial ownership, and then we'll move on to the final issue. But the last question, you mentioned that new legislation coming out, which is October 30th, and that's because your Labour Party won the election.
Yeah, so we
now
have
they're
change,
looking to.
Yeah,
okay,
change of government, and we are in a bit of a pickle with our taxes and paying lots of things, services and everything else in the UK. So it's inevitable that taxes will go up. We're just trying to work out where, and there'll probably be lots of tax planning exercises happening straight after that budget.
So on October 30th, because I mean, everyone's going to be watching what we do in the US next year when we have our calamity of our tax code. So I get to pre-watch what happens over in your side of the pond.
Yeah.
I'll pop my popcorn on October 30th and watch the drama unfold on that day.
Yeah,
okay.
Absolutely.
Got it. All right. Adam, tell us about beneficial ownership and kind of, how those things register in Poland. Is it the same thing? If I open up a entity or a trust, all that stuff gets published and everyone knows what's what, or is it more concealed?
Yeah, basically there is a special beneficial owners register, which is publicly available, and there are quite high penalties for not registering over there. So just for the administrative omission, so you do not, have any tax arrear, just not register on time, you can get fined quite seriously. And it comes down to beneficial owners as individuals. So all the companies, we basically don't have things like trusts which are tax transparent or transparent in any way. We have some partnerships that are tax transparent, but in that case, the beneficial ownership tracking is quite easy as well. The more because you can check it in the company registrar. The more problematic thing is with companies, because they may have shareholders which are companies located in Cyprus, which have shareholders from Dubai and so on. And on the top of it, you can have a Polish person over there. So the obligation to register a beneficial owner will cover them. So even though there are different shareholders in between the individual and the Polish company or another entity, you need to register the individual as an ultimate beneficial owner in an official register, which is publicly available. So basically, yeah, all is public, but there are some solutions to that for people that do not want to, go fully public, as, for example, some kind of power of attorneys given to, but then you have to make the attorney responsible for many things in your company, but it is manageable.
Got it. In the United States, we have a newly issued thing called the Corporate Transparency Act. And so despite what people may think, because of what you see in Hollywood and our movies and our TV, our law enforcement agencies are not as sophisticated. We don't have access to all the LLC information. And so the point of that act is to create a national database of LLCs and who is the ultimate beneficial owner. Supposedly, there's, I think, 36 million filings that are supposed to occur this year, and they need to be done by December 31st, 2025. However, year to date, I think only 2 million LLCs have filed, so it's a big miss. It's a big whiff on our side. There was also talk about New York separately created their own beneficial registry for the state, and they talked about actually publishing all the owners. We don't, under the federal rule, you don't publish anybody, and there was so much backlash to that New York quickly walked that back, and so they're not gonna publish that. But that goes into effect next year. So for those that have LLCs federally or in the state of New York, be careful. Make sure you do that reporting. Rob, we have another question.
I was just going to give you a 5-minute warning for the session, so probably Michigan. Final points.
Yeah. So very quickly, which is I think what a lot of people are also asking about here. Do you guys just want to quickly give me your top 3 things to think about from a cross-border perspective? Let's say you have a Polish influencer going to the UK, or Kathy, you've got a UK influencer or athlete coming into the US. What's your big 3 that you're going to say, hey, before you cross that border, get in there, this is what you need to think about? We'll start with you, Kathy.
Mine are kind of the hidden costs of touring, if you like, the hidden costs of that you're perhaps not expecting when you're trading outside of your home jurisdiction, and those are withholding taxes and social security deductions, and also if you're taking people with you. So for a lot of these people, they're taking film crews with them, and things to consider are, on your own income, are you being paid something that will trigger withholding tax deduction, and can you do something to minimize that withholding tax deduction? And then once you've earned that income, minimize your withholding tax. Do you have a filing obligation because you are trading in that country? And then in terms of your staff, your crews and your entourages that you're bringing with you, do you have any obligations, payroll deductions, withholding obligations, social security on their behalf? Social security is something we haven't really touched on, but something that is a direct cost to trading outside of where you live if you pay social security in your home country, something that is very easy to avoid. Most countries have reciprocal agreements, totalization agreements that say as long as you can prove that you pay social security in your home country, you do not have any deductions outside of where you live. And some of these territories that some of my clients work in, France, Italy, for example, the social deductions can be anything up to 33%, which is massive.
Yeah, that's
and
a lot.
one piece of paper will mitigate that entire cost. And also social security isn't something that you can deduct against your social security back home. It's a direct cost of trading in those jurisdictions. So to me, that's a must. That's my top tip.
I love the one piece of paper mitigation. That's fantastic. That's great. Adam, what do you got?
Yeah, actually, this paper is also relevant here. We have people, traveling mainly around EU, and you can say that it's mainly, but due to this fact, the geographical proximity, the crossing of the border is very frequent. So it's not like people go to this country and stay there for some time. They can go around 27 countries in 1 month. So the basic idea is where you are a tax resident. So this is the key to determining all the rest, the baskets of income, what kind of income, how to tax it, withholding tax. But first you have to make sure whether you stayed a Polish tax resident, for example, regardless of the fact that you traveled to Spain, to the UK, to the US. And no, if you travel to the US, I know that the IRS will treat you as a tax resident till the rest of your life, especially if you have that green card in your pocket. But from Polish perspective, 183 days, if you didn't stay 183 days in Poland, it is not enough to say that you stopped being a Polish tax resident. There is also this center of vital interest criterion, which is a very poetic phrase, but it comes down to your personal situation. For example, you travel around various countries during the year and you don't stay anywhere for more than 30 days, let's say, or 60, because this is, I think, the shortest period required in Europe, which is in Cyprus. But you have still your closest family members in Poland. You are a Polish tax resident due to that fact. And all the income that you generated in various locations should be taxed in Poland. Of course, you can then deduct some local taxes that were withheld and so on, but still you have to file your tax return here. So determining this fact is a key, which many people go around because they travel and then they pay taxes, and they pay it in Spain, they pay it in France, they pay it, I don't know, in Luxembourg to some kind of marketing company, but then they come back to Poland and there is a letter waiting for them from the tax office. Let's talk about this new marketing campaign that we have in the center of Warsaw with your face on it, for example. So yeah, the tax residency is a top idea from this.
Yeah, so briefly, just to close out, in the U.S., there's no magic piece of paper. The tax residency is critically important. I think a plan is what I would tell anyone, that the number one thing. We have, for example, we have some cross-border CrossFit athletes that come in from foreign countries. They're competing in the CrossFit Games in August. They came to Tennessee, to Nashville, to work out a couple months in advance. They were told Tennessee has no state income tax. They didn't think about the federal tax, and so we had to talk to them about, hey, got to be careful how long you stay. There is a federal tax obligation. We've got to work that through the treaty. There may be some entity planning that we want to do. You've got influencer income. You've got prize income. So I think from the U.S. side, I would just say kind of a pre-immigration tax planning approach, even if you're temporarily in the United States, is always a good kind of solid rule of thumb. Back to you, Rob.
Well, I think thank you very much, first of all, to our panel today, Mishkin, Kathy, and Adam, and to all our attendees. Thank you very much for joining us. There are a few outstanding questions, Levi, Dean, Alfredo, and Paul. I will make sure to share these with our panel so that we can get back to you offline. But in the interim, if anything has piqued your interest or there are any unresolved questions or thoughts, please do reach out to our panel. They are experts in their field. And if the jurisdiction isn't quite as relevant, the beauty of being part of Nexia, we have over 125 countries that we can call upon in order to answer various tax-related questions, especially when it comes to the high-profile athletes, entertainers, and for me, being a millennial, not too sure about, but the influencers, I'm certainly not one of them. But thank you all very much for your time. Thank you, panel, again. And please do check your emails in the coming days, because we will be sharing this recorded session for you to use within your firms, and also some supporting documentation for your information. So thank you very much and have a wonderful rest of your day.
Thank you.
Thank you.
Thank you.
Bye.